I want to walk through a couple of examples of the pricing approaches that I talked about in the short introductory video that I did. So what I'm going to do is I'm going to walk through two examples, one that it uses cost plus based on the target return on investment, and then one that looks at market-based pricing. And these examples I'm walking through are actually problems that are in your book. So if you want to look at those while I'm going through this, you can. The first one is 13-29. And what we have here is a company, Sweet Tastings, who makes candy bars for vending machines, sells them in cases of 30 bars. They make a variety of candy, but the cost differences are insignificant, and the cases all sell for the same price. So we can look at everything together. They have a total capital investment of $10 million, and they expect to produce and sell 400,000 cases of candy in the next year. The company requires a 10% target return on investment. So you see, I've included that information in the data. Now, additional data. The variable production costs are $3 per case, and the marketing costs, variable, are $2 per case. We have fixed costs for production, marketing, and other that are identified. So all of that is the data they gave us. In the first two requirements, they want us to A, calculate the operating income, and then B, come up with what price we should be charging based on the fact that we require a target return on investment of 12%, and then come up with a markup percentage. So targeted operating income is very simply the investment of $10 million times the 12% required rate of return. In essence, what that means is that they need operating income of $1,200,000 in order to achieve their target. Now, to get to the price, we can add in the fixed costs of $1,600,000, which is just the sum of the three categories of fixed costs that were provided. If we add those two together, that gives us a required contribution margin of $2.8 million. Remember, contribution margin is revenue minus variable costs. In order to cover all of our fixed costs and achieve our targeted operating income, we need a contribution margin of $2.8 million. That's what this is telling us. Then all we need to do is calculate variable costs, which I have done by taking the two categories of variable costs per case and multiplying them by the 400,000 cases that we estimate we will produce and sell. If we add the variable cost to the targeted contribution margin, we come up with the total amount of revenue that we would require in order to meet our targeted operating income, and that's $4.8 million. Then from there, it's just a matter of dividing that by the estimated sales to come up with the price or charge per case, and that's $12 per case. Now, the second part of this requirement was that they wanted us to calculate the markup percentage on full cost. So to do that, all we need to do is take the price we just calculated of $12, subtract from that the cost per case. Now, the fact that they want us to calculate the markup on full cost means we need to include both variable and fixed costs and both production and marketing costs. So what I basically did to do that is I took the fixed costs that we've already summed up in B17 and divided that by the number of cases to come up with a per unit fixed cost. Then I just added in the variable costs from above. And what that gives us is a full cost per case of $9, which means the markup, the difference between what we're charging our customer and our cost, is $3 per case. If I take that and divide it by the price, that is, or I'm sorry, divide it by the cost, that is a 33.33% markup. So we're marking our product up 33.33% above full cost. Remember from the other video that I did that a company can choose to do full cost, variable costs, or variable manufacturing costs. This is a safer bet because you know the markup is only going to represent your profit. Now, the last thing they ask us to do is to kind of walk through a what-if scenario. What if we raised our price to $13? Our marketing department thinks if we do that, our sales will drop by 10%. So I've got a revised charge, and then I have revised number of cases sold, which is the 400,000 at 90%. That's going to give me a revised revenue of 4,680,000, the 13 times the 360. Revised variable costs equal to the 360,000 times the two categories of variable costs, $3 and $2. And that will give us variable costs of $1.8 million. If we subtract that from the revised revenue, we're going to have a revised contribution margin of $2,880,000. Notice we don't care about fixed costs because in the problem, the fixed costs are going to remain the same at this level of capacity. So in this case, would they make the change? It seems like on dollars alone they would, because in the initial scenario, we're calculating a contribution margin of $2.8 million. That's the minimum we need to achieve in order to meet our targeted operating income. In this scenario, we're actually producing a contribution margin of $2,880,000, which is $80,000 in excess of our minimum. So on numbers alone, this would be a good, positive change to make. Okay, let's look at this other example, which is also in your textbook. It's E13-31. In this case, we have a labor contractor. They supply contract labor to building construction companies. And for the year in question, they have budgeted to supply 84,000 hours of labor. Our variable costs are $13 per hour. Fixed costs, $168,000. And we're proposing a cost plus approach for pricing our labor to be 20% of labor at full cost, similar to the previous problem. So in the first problem, they just want to know, or first requirement, they just want to know, based on those parameters, how much should we charge per hour? The approach is very similar to the previous problem. Labor costs would be $13 times the 84,000 budgeted hours, or $1,092,000. Fixed costs then would be the 168,000 that we have identified. That's going to be full cost of $1,260,000. That's just the sum of all our costs. If we divide that by the number of hours we're projecting of 84,000, that gives us an hourly cost of $15. And that's a full cost. That includes variable and fixed. Based on that, our price per hour is going to be 15 times 1 plus 20%, or $18 per hour. All we've done is determined our cost and added the markup of 20% to that, and that's what we're proposing that we would charge. Okay, that's a great starting point. Now, here's where the market issue comes in. If we look at requirement 2, what has happened is our marketing department has given us an estimate of demand for different prices. So in other words, if we're only charging $16 per hour, our demand is 124,000 hours. Clearly, as the price per hour goes up, the demand goes down. So as we increase our price, building construction companies are going to be less likely to demand our services. And so what the question actually asks is, which price per hour based on our market is going to maximize our contribution margin, which effectively maximizes our operating income? It's important to note that we're assuming in this that at all levels from 61,000 to 124,000 hours of demand, our fixed costs will not change. That being the case, we don't care about our fixed costs. If you look, though, you'll see that at $19 an hour, we're maximizing our contribution margin. And all we're doing here is subtracting the variable cost per hour, which by definition won't change. It's $13. And so the contribution margin at $16 per hour is at 3, and then it moves up by $1 until we get to $7 per hour at a price of $20 per hour. Then if we multiply that contribution margin per hour by the demand, that gives us our contribution margin at that demand. And you can see clearly that the highest contribution margin is at $19 per hour. When we go to $20 per hour, the demand drops such that our contribution margin and therefore our operating income will actually decrease. This is where we look at the market for the pricing. Yes, we can have a cost plus at 20%, but what does the market say about it? And the market basically says we can actually charge a little more than that, which will, of course, hit our bottom line. It's good to consider both the costs and the market, because in essence, we've got to meet the market, but at the same time, we want to meet the market with a product that we can actually afford to produce and still make operating income, still make profit.